Are you ready for liftoff? Don't miss Canada's #1 cannabis conference and trade show, Lift & Co Expo, coming this May the 12th through the 15th to the Metro Toronto Convention Centre. Level up your industry intel at the Lift Cannabis Business Conference, plus connect with movers and shakers from across the cannabis industry and preview new products and services from over 250 exhibitors. Plus, everyone loves Lift & Co Expo's prizes, live music, and more. Visit liftexpo.ca for tickets. That's liftexpo.ca.
Welcome back to The Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today I've got Rob Sechrist. He's the president of Polaris Equity Group. We're going to talk about some demand in the markets as it pertains to commercial real estate and some investment. Rob, thanks for being on the podcast.
Thanks for having me.
Well, I'm going to switch over, share my screen so we can take a look at this article. It's cannabis legalization driving demand for warehousing and retail. So are you seeing an increase in the amount of warehousing? Because we haven't even seen drop shipping yet, which would benefit California, going from the Emerald Triangle, all the way down to San Diego, over to past the mountains to Nevada. Have you seen an increased demand for warehouse and retail storefronts?
Yeah, so this is a great opportunity. We're familiar with The Real Deal. We work with them a lot, and in this article too. So there's a couple of things to know here. First of all, just in any cannabis property that you're going to have, I just want to clarify for some of your investors or your podcast members here watching, the properties must first be in a green zone, an area that's designated in that city to be eligible to have cannabis use properties. And then that specific property itself must be designated and get a conditional use permit that applies to just the property. Once that conditional use permit or CUP is in place, that property can forever have cannabis use tenants in there, and there's an added value that comes with that conditional use permit. So going into the specific example, we are seeing massive demand. There are all kinds of properties that are being built. Now, this particular article is talking about warehousing, and I wouldn't necessarily say that that we've seen just a property being acquired to store or to warehouse. I haven't seen that happen, and we've seen, I think, we've got 143 loans in our pipeline, and not one of them is just specifically for warehousing, but they would all warehouse some. The vast majority of our stuff is some type of value add transaction, because no cannabis properties really don't exist today yet that are, some portion of it is indoor grow typically, some portion is extraction, and maybe they have some of them have dispensaries in the same property themselves. And most of our stuff is not in the downtowns or the urban areas. Those typically seem to be higher CapEx costs, and our loans that we do, people are coming to us more for the build outs, for the ground up construction or the tenant improvements for the properties to be built. The dispensaries, which are typically more found in the urban areas, they don't need that same budget, and there's about 4 dozen private lenders that are doing those, and we don't do that many of those types of transactions. And if I could just add one quick other element to this, the tenant improvements that are necessary for a cannabis-related tenant are so massive that I'll just give you a quick example. One of our transactions for Candescent was a $4.5 million purchase price of a 27,000 square foot facility that already had its conditional use permit in it. That property, to get it so that it could be fully stabilized and built out for the tenant, was another $4.5 million in tenant improvements, so $9 million in costs. So we did a 50% loan to cost on that transaction. They brought $4.5 million to escrow, and our $4.5 million sat in our trust account. We doled out 80 draws in 12-month period and got that property fully stabilized, and it's now up and running and doing $1.3 million a month.
Wow. So I wanted to ask you if you're seeing a different type of investor coming in. Is it vultures yet? Is it value investors seeking to purchase existing licenses? Because we've seen the demand. Definitely, California has $20 million licenses. I've seen in Arizona, like Phoenix, you're seeing partial licenses go for $5 million. To your point, in Las Vegas, with the restrictions on warehousing being a certain distance from schools and churches and all these requirements really adds or increases the value for these properties. And in every single rollout, in every single market, we've seen an increase in demand. And so I guess two parts. Is that still the case with the way that the market has gone? Is your pipeline still in existence? Is it dry? And who's making up that demographics?
Sure.
Are the investors the same, or are they more value vultures or otherwise?
So let me clarify that our investors are members of our fund, and we are facilitating the debt for somebody that is maybe a vulture, but most likely is a brand or somebody that's a property owner that has their own reason to build that property out. But to go more specifically into, I think where you're headed with the question, we do believe that there is going to be some shakeout here, and there is going to be massive opportunity for operators that may have even been successful operators, but they simply ran out of cash while they're trying to get their facility stabilized. You can't generate money until it's built. And if you're run out of cash because it took longer than you thought and it cost twice as much, they may not be able to get that property stabilized fast enough, and they might have to shutter that transaction or that property to help the balance sheet for the entire portfolio of properties they have if they're a multi-state operator. That is probably coming, and that'll be a massive opportunity for the buyers of these properties, but that's not us. We just facilitate the loan to do that, and we are experts in doing that. We have the ability to not only do that for an acquisition, but we can do it if the project is what we call a broken project, which means that they only got it partially completed. It may have been a fully built building, but the tenant improvements were only 50% complete, and it still needs to be built. And in that particular circumstance, that's a very special type of loan because it's very difficult to get title insurance on those and all kinds of things that go along with it. And we are experts at that. So we're prepared for that. We haven't seen it yet, but it'll be probably happening in the very near future.
Yeah, I think MedMen is probably one of the greatest examples of kind of the industry switching a little bit. I think High Times as well. They went from a publication to a brick and mortar. Ease, which is a delivery service backed by Snoop. They went from trying to be an app delivery service to an actual brick and mortar. But so there's a lot of shift, a lot of changes. It's hard to kind of have a crystal ball and see what's going to happen. But looking at MedMen's example of how the industry is shifting and moving and dynamic, kind of wanted to get your take on what they're going through. So in case anyone is not aware of, so MedMen said that it had partially sold off its stake in a REIT manager for total net proceeds of $14 million. MedMen's CEO didn't return phone calls for this particular Real Deal article, but it's been far from smooth sailing. According to this article, nearly 10-year-old MedMen became the first U.S.-based cannabis company to go public on the Canadian Stock Exchange in 2018. Retailer roughly had $105.6 million in debt at the end of March. So they're doing a lot of the sale leaseback options, liquidating any property, plant, equipment in some cases in order to be cash rich. Are you seeing a shift away from buying real estate with sale leaseback options, or where's the market from your perspective?
Sure. So let's just kind of use their example here. So MedMen has dispensaries, and they need cash on their balance sheet to sustain the storm. They also have an indoor grow facility, and it's right next to our Candescent facility. It's one of the nicest ones we've ever seen, but they overspent on that, and they overspent on many of their things, but that's okay. That's their business model. They just weren't able to bring in enough revenue before they ran out of cash flow. So what MedMen is doing is selling off assets in various different ways to try to bring cash flow back and save the company. And there's various different ways that they can do that. They can outright sell the property if they happen to own it, which I don't know if they own all of their dispensaries directly or not. We've seen requests for loans from them over the years. We've also seen requests for loans with them as the tenant. And what they're trying to do is the assets that they own, they're trying to get out of those or sell those and such as the indoor grow facility in Desert Hot Springs, which they sold off Treehouse Real Estate Investment Trust, which is a cannabis real estate investment trust that owns properties. And once they sell that asset to the REIT, then they can do a lease back from them. So they're trying to get some cash off of onto their balance sheet to get through these times. Mm-hmm. Them and various other operators that may not have gone so deep on spending before they ran out of cash flow, but other ones are no fault of their own, just the cost took more than what they expected, and the time took more than they expected, and they simply ran out of cash flow, and you can't generate the profits until you have that facility up and running. So there are guys that are brands that have good companies and good operations, but they try to do too many at once and they're running out of cash flow. There's going to be amazing opportunities, and we're seeing a lot out there right now where we're able to, by being the lender secured by the real estate, that we're able to make it so that the tenant that is coming into that property, which is traditionally the one that needs to pay for those tenant improvements because they're so massive, we're able to step in and offer a loan to the owner of the property. And our loan includes the tenant improvements that would allow that tenant, that operator, to be up and running. And so that saves millions of dollars from these prospective tenants and makes it so that they have a better opportunity. That's where we're succeeding right now, and that's where we're really stepping in and saving these guys. So as opposed to the tenant operator or the cannabis brand having to use their own liquidity on their balance sheet to complete these tenant improvements or sell more of their equity in their company, we're able to do it by putting those tenant improvements, because they're improving the real estate. We're able to do it in a debt loan that is secured by the commercial real estate.
This is the part where we're going to get high, 30,000 foot level, take a look at some investors targeting distressed cannabis companies for new opportunities. So this article from MJ Business Daily says that there's an increased number of investors, including mainstream investment banks, that have begun seeking out cash-strapped marijuana companies with the aim of pumping money into them to provide financial lifelines. The investment offers the distressed companies a chance to get back on their feet. In return, investors get the opportunity to take financial stake in the company, restructure it, put the business on the road to recovery, all with the aim of making profit on the investment. So with your future 2020 crystal ball, is this more of an opportunity? Do you think people are going to be leaving the Canadian marketplace looking for the US as a value opportunity? Do you think they'll be going to existing markets rather than new markets because they can buy an existing license with that experience cheaper than maybe starting a new one? Where do you see the market moving forward?
So, we only lend in the US market, but the Canadian market was all this capital and no companies really even existed. And it's a difficult place to grow. It takes, you've got the winter, you've got to heat these places, you've got moisture, and it's a difficult place up there. And to make a comparison to the US market, where there's no capital essentially available from public markets, and you've had a pretty robust illegal market going on for probably at least 100 years, I think it's apples and oranges to look at those two. I think that the US market is massive opportunity and growth, and it's the opposite of the dot-com boom, where there was all this flood of capital that came to these businesses. In the US cannabis market, there's been limited supply of capital. And so it really has been staggered growth at best, and coming from private investors and private banks and things like that, and guys like us. I think there's a lot of opportunity here in the US market. That's what we're focusing on. I think the Canadian market is going to do okay in the end, but they've already, I've got some Canadian stocks myself, and those, some of them are down 90 and even 95%, and they were down so low that I during this COVID-19 I purchased a whole slew of those, because I figured that even if they went down 90% from today, their upside is so massive. Going from $2 down to 20 cents they can make that back. And I think that those markets will will recover, but there's going to be some big shakeouts there. There's going to be some shakeouts on all this stuff. Remember, nobody has done the scale of these operations ever. The people that know how to grow, the people that have been doing this over the last 100 years or whatever in the last generations, most of them were doing it outdoors, and the ones that were doing it indoors were doing it on a small limited basis, in the basement of some house. Nobody was doing million square feet at once. Nobody knew the right lighting and the right moisture and the right CO2 and all of this stuff that's being put into this. So everybody's trying to figure it out, and there's some people that have had the experience and the expertise that are starting to emerge, but everybody's just trying to still figure out what's the best way to go. Most people now have figured out you don't want to have a 1 million square feet in one single room. You got to protect and compartmentalize those crops if one of them gets contaminated, and all kinds of other things. So we're starting to see. I've got some videos we're just about to launch a Polaris YouTube channel that shows some of our facilities, and I go more deeper on a lot of stuff. And you can see some of the assets on our page, our website at polarisequitygroup.com. We're posting some of that stuff in the very near future. But I always want to see people to see what these facilities really look like inside. They look like a FDA laboratory inside there. At that level, you've got to wear, hair and protector and masks, and you got to step in and clean your shoes off to keep the contamination. They're very sophisticated. These are top high-end operations, and we'd love to be able to show you some of those assets in a future podcast.
Yeah, love to see it. Well, we're definitely seeing a lot of driving in demand for whether it's real estate, for warehousing, retail. This Real Deal article says that it's especially hot, used for both storage and growing cannabis compared to 2017. Last year's demand increased for warehouse space 42%, a market where recreational cannabis was legal for more than 3 years, being Colorado, Oregon, Washington, and Alaska. Demand increased 34% in states that legalized cannabis post-2016. So demand in states without recreational legalization increased 18%. So there's definitely an increase, it looks like, because of the limitations on where you can go. I'm curious when people will start looking at tax havens, legal opportunities like Puerto Rico offering 4% corporate tax cap for companies that want to move there. California might be enticing for somebody in California, or if you're already in Florida, why not just jump and manufacture CBD in the meantime to take advantage of 50% tax credits and 100% tax deductions? You just got to deal with the Jones Act and shipping that from Jacksonville, I think is where that's at.
So let's, I realized that when this article is discussing warehousing, in reality, all the indoor cannabis properties are warehouses. That's the property. So I think that they're not actually warehousing. They're using warehouses. That's what's pertaining there. Regarding Puerto Rico and those tax havens, I'm just thinking off the fly here, but each state that you have a license in, you have to be domiciled for that corporation in that state that owns that license. So you've just effectively lost the ability to get any tax havens because you'd have to be domiciled in Puerto Rico. So that's not a non-starter. And there is
what about sorry to interrupt, but what about an entity? Like if you had a research and development for terpenes or a bilingual call center, having an entity in Puerto Rico could still take advantage of all of those without having to be headquartered there.
So ancillary, yes. And we've got somebody that we work with in Puerto Rico. We have 2 people that we work with there that are ancillary. And we actually use a W-8, I think, to pay them, which is the tax-free form that we use to show how their income is derived. So ancillary, I think you could do that. And ancillary my next point was going to be, you can't cross state lines with one from one state to the other with anything THC. So, but ancillary stuff you certainly could. So yeah, in that scenario, Kush Holdings could potentially move their operations there. But it just depends on what they are. And a research company would certainly be a good one because you could do the research and distribute that out without having to actually ship it.
Hmm. Yeah, I'm wondering if THC companies can do the same thing, a Spanish bilingual call center to help them sell more of their THC products in existing states, or like I mentioned, the terpene research and development for their THC products. I'm wondering if they can get uh, tax exemption, or at least take advantage of Act 20 being in Puerto Rico. I mean, I'm no CPA, but it seems like a fairly complicated subject. But I guess without getting into the weeds, my point is I'm wondering when that's going to happen, when companies are going to start looking for that next advantage, with all of this carnage and limited opportunities for companies like you to give them that lifeline.
So what most people may not realize is that most of the cannabis green zones are in opportunity zones. And opportunity zones are if the owner of the property that's buying that property is a qualified opportunity zone candidate, they are using money for that. There's a way you can do that right now, and that's already being done. One of our friends has a cannabis-focused opportunity zone fund, and they're doing very well. So that's something you could do and be directly in the cannabis business with that. I'm sure people are trying to develop strategies. I mean, we did it with you converting to the REIT. So everybody's looking for the ways to reduce taxes and to maximize profits to themselves or their investors.
Mm-hmm. That's interesting. So tell me a little bit about yourself and your company and the new venture that you're in.
Sure. So Polaris Equity Group is a asset-based lender. We've originated more than $1 billion worth of transactions, over 5,000 value-add lending transactions between myself and the other principals. We formed Polaris in 2010, and we used to get our investors, 11, 12%, and over time those yields compressed down to 6 to 8%, and more importantly, the LTVs went from 65% loan to value to 70 and 75 and 80% and even 90% on purchases these days. So we started looking for alternative lending products and what we wanted to do. And back in 2014, the Rohrabacher Luminar amendment was passed, which defunded the Department of Justice from any prosecution of any cannabis-related business in a medically licensed state. Once that amendment passed, we felt comfortable using our lending expertise, and more specifically for the value-add space, to apply it to building facilities for cannabis use. For our borrowers. And we also realized that when we analyzed that the cannabis use properties, the revenue that are generated by the tenants are orders of magnitude higher than a traditional tenant. And so the importance of getting the draws processed and the money flowing to the contractor so that facility can be built quickly was exasperated and so much more important, and it became less of an issue of what our pricing was and more of an issue of how quickly we could facilitate getting these properties built for these guys so they could start generating revenues and then pay the lease to our borrower that owns the property. So we've been originating transactions since 2016. We've done about 33 of those transactions to date for more than $65 million. We've had perfect performance in the cannabis sector since we've entered that space. And it took off so fast, and there was nobody in the space when we entered it. There was an actual lender. There was a couple of individuals and family offices doing one-offs, but nobody was set up as a lender that we could find at that time. And so we launched the Polaris Fund in 2018. And that we utilized that fund to accelerate the ability for us to raise capital. And then we just recently converted that fund to a private mortgage REIT. And just to give you a little bit of the structure of how that happens, because we already had the fund and it was licensed and all the things that go along with that and all the members of it, the way that we do it is that the fund actually fully owns a REIT, which is actually called a sub-REIT. And by owning that REIT, it allows all the fund members to get the benefits of being the tax advantages that are afforded by a REIT status, which, just to clarify what those are real quick, 20% savings on your federal taxes on interest income, and it extinguishes the possibility of UBTI for self-directed IRAs. And also the fund members, they pay taxes from their K-1s in their own states that they're domiciled, which the reason I mention that is because we're a national lender. At a certain point, we were going to cross the thresholds of allowable pass-through income, and we were going to have to start filing tax returns in multiple states. But the REIT allows us to not have to do that, and now it transfers the taxes for the K-1s for the members to their domiciled state, which is really important. And it's super important for those investors that are in, I believe, 7 no-tax states out there. And so they effectively got the 20% tax savings on the interest income for federal. And if they're in a state that has no taxes, they've got no taxes in those states. So those are just some of the advantages of it. And I'll turn it back to you to answer more of your questions.
Yeah, I mean, you mentioned a few things that I kind of want to, dive into a little bit more. So for those that don't know or forgot or whatever, real estate investment trust or REIT, to simplify it, it's kind of a blank check system where you can go out and have a fund that is able to go and buy either commercial or residential real estate. So that's kind of a short, quick version of a REIT.
Yeah. So, and this is a really important distinction. And let me just first clarify that our fund is a cannabis-focused commercial real estate debt fund. So the reason I clarify that for you is because the traditional REIT, real estate investment trust, that model was to own properties. And that model is being used by, I think we've got 6 to 12 of those already out there that are cannabis-focused. A traditional REIT owns the property. We do not own any properties. We are a lender. So we are a private mortgage REIT, which is a difference. So we don't own any properties. We could push out $1 billion and manage that with probably 10, maybe 20 people at the most, because we're servicing loans and we're processing draws. We're operating as a lender, not as a property owner operator that owns all those. And it's a much more heavy lift to be able to manage and own all those properties than to just simply originate the transactions. So we don't own any properties.
Okay. But you did see an advantage with the increase in LTV. So as that loan to value went up, you obviously saw some opportunities and started formulating your next strategy, but it was more regulatory, was it not? Can you kind of explain kind of how that perfect storm happened?
Sure. So let me just kind of unpack something. So the LTV example that I use was the non-cannabis lending, which the market that we used to be in. There was so much capital in that space that was driving the yields from the low double digits to the mid to single digits, that not only did the yields compress, the LTVs went up, and we weren't comfortable being in that space anymore. And so the example that I was getting on those higher LTVs doesn't pertain to us. Our average LTV is 50%. So we are significantly lower on the LTV and significantly higher on the yield. And in addition to that, the traditional non-cannabis lending that we did, the personal guarantees that we got weren't from people that we really were able to enforce very many of them and have much clawback there. In the cannabis sector, these are all guys that would easily qualify for bank loans in traditional banks underwriting, but they simply aren't able. There's limited lending out there, and there's a big misconception out there, and I'll just touch on it really quick, is that 8% of the U.S. banks are actually cannabis-friendly depositor banks, and I think it's like 743 of them. And in addition to that, there are numerous credit unions that are lending directly to cannabis operators. And there's about 8 that we've counted FDIC-insured state chartered banks that are lending as well. So these are big things that most people have no idea that actually even exist, and it does. So even though the cannabis hasn't been deconflicted federally, it's still, everybody's still lending and kind of going about their business. Where the big difference is that the most efficient capital markets in the world aren't able to participate yet. So we've been in an industry trying to fund things privately and the best ways that we can without having the most efficient markets there backing this, and that'll happen somewhere down the road.
I wanted to ask you also about that bill or amendment that you had mentioned. I hadn't actually heard about that. You mind kind of unpacking that a little bit?
Yeah, it's a really, really important one. So it was started as the Rohrabacher Luminar Amendment, and that's Dana Rohrabacher is actually a friend of ours here, and he's our was our congressman at the time. And so that bill, just to re-clarify what it is it is Congress, this is in 2014 during the Obama administration, Congress defunded the Department of Justice from any prosecution of a cannabis-related business in a medically licensed state. So what that means is that regardless of what administration is in power, what executive branch could utilize the Justice Department to enforce the laws, even if they were against cannabis, there's no money. They are used the power of the purse. There's no funds available to do it. So they can't enforce those laws. And so why that's so important is that Congress has taken away the power of the executive branch to enforce those laws by pulling the money. That law is a standalone amendment, which means that it is on its own and it actually has to be renewed every year. And it has been successfully renewed every year since 2014 with overwhelming bipartisan support. This year, it looks like it's going to go from a standalone amendment into what's called the Omnibus spending bill. The Omnibus spending bill is the budget that the federal government passes every year. And when that Omnibus spending bill is passed, it passes everything that's included in there. This amendment is scheduled to go in there. And once that happens, there's absolutely no risk that this amendment will ever not be passed again in the future. So that's the safe harbor that we felt comfortable. It's not technically a safe harbor, but that's where we decided we felt comfortable entering the space.
Interesting. That's good. I mean, obviously, I think everyone's looking at the potential tax revenues and not wanting that to go away. So, however they do it, we'll take whatever win we can get.
Yeah,
just to stay in business.
I've never heard of a state getting rid of tax revenue for themselves. The only time that something got wiped out was from a prohibition of alcohol, but that was a federal mandate as well. But we don't see any state turning away from cannabis, and more states are coming online. And it seems that we have relationships with Cory Gardner, who is co-sponsor with Elizabeth Warren on the States Act. And he's in the Senate, and the House is an easy side of Congress to get all the bills through. One of the various 40 bills that do different types of ways to get this more deconflicted from the federal rules. But the Senate is a little bit more difficult because it's controlled by the GOP. But Cory has personally told me that he actually has the votes, enough votes to get the majority through on the floor vote, not just the committee vote. And that's very interesting. And the only reason that he didn't take a run at it this year is because it's a presidential election cycle, and his co-sponsors, Elizabeth Warren. And if they try to bring that bill to the floor for a vote, because it's a presidential election cycle, that the other candidates would have said, it hasn't gone far enough. It needs to be federal legal. You need to let everybody out of jail. You need to have reparations to people. And he would have lost the GOP support for the bill. So as we get a little bit farther down the line here, he said that there's a possibility if he gets a window, he'll take a run at his bill. But probably next year, because we're out of the election cycle, I think somebody will get something passed through.
That's good. I know there's a lot of bills that got pushed out of the way. In Washington, it's been a felony for 5 years to have any kind of cafe. So it's a Class C felony to maintain and operate a marijuana lounge. So I kind of came out of the gate with the Seattle Super Chronic Cafe about 5 years ago and have pivoted to stay relevant for half a decade, waiting for that, and then ended up joining the Cannabis Alliance, little committee to lobby against that, wrote a bill, but with the current market calamities, I can't really push that bill right now. There's a lot of other priorities. So maybe next year, I know there's a lot of other bills that are taking a back seat to, coronavirus and everything else. So hopefully some things will work out. I know that banking seems to have lost its traction with the Safe Banking Act and some other safe harbors, but hopefully those will get back on track.
if I could just add on the banking, most people don't realize that most of the banks that are gonna do depositor relationships are already in. I doubt that when you're a big bank, a big national bank, there's depositors that they have that are that might have a moralistic they're opposed to it moralistically, and the deposits that would come on from the cannabis people, depositors, are so insignificant to have that moral stigma that I don't know if by the laws changing, it's going to change the tide for very many other banks at this point. Most of them already that have made that decision have already, I think, emerged into it. Of those banks that I mentioned, I think it was 743. There was only like 8 or 20 banks that were added over the last year, so that it's already kind of plateaued. So what that's kind of telling us is that most of the banks that want to be in the space are in it already and prepared for it. And so that's only depositor banking relationships. And there's 2 components to that. There's tier 1, which is plant touching, which they have to track and trace every single dollar from all the way from the driver's license, the person that bought it at retail, all the way into the bank. And just so people know, you actually have to pay a flat fee, typically something like $1,000 to $1,500 a month, regardless. And you actually have to pay like 0.2% per deposit to deposit your money. But it's just because there's such a huge compliance issue with that money. Or there's tier 2/3, which is ancillary, and that's what we are. And even though we're completely non-plant touching, we were in a major institutional bank and we lost our banking just because we are a high-profile company and we do a lot of stuff like this, and they just don't know. Once they decide that you might have the possibility of being in that business, you don't get to fight that battle. They close your accounts, they give you 30 days. And if you have dozens and dozens of accounts and lots of entities and lots of trust accounts, it's a freaking big pain in the ass. And especially if you were an operator, or if you were a real estate guy and the bank called your note because of that, and it could cause a cross default on all your stuff. You could lose all your banking, and we have one of our larger investors is that we've been working with, a multi-billionaire, and they had to think those things through before they started to enter the space, because they have massive lines of credit for non-credit cannabis related stuff, but they're all in the same bank and they close all the accounts no matter what. It's a big pain in the ass.
Yeah, we're seeing some banks forcing people to close out their retirement accounts that they got from corporate America before jumping into the cannabis space. So, getting charged 30% or whatever for a retirement account is a serious consequence of getting into the cannabis space. So, maybe we'll leave that for another podcast with banking, because I think there's going to be a whole lot of consolidation as some bank runs or potential for bank runs occur in the future, even with $2 trillion or $1.5 trillion in bailouts. But again, that's another podcast. Anything else that we didn't cover before we roll this one up?
So I think one other thing that 280E is important for the operators, and that's the inability to deduct the expenses for a cannabis operator. There's some accounting rules of getting around that for those guys, or to lessen the effect, but that's one that is really important. It gets resolved, and many congressmen and women are working on that one. And I always like to share that most people don't realize that rule was put in place after Pablo Escobar was prosecuted by the IRS or by the DOJ for not paying taxes. And most people don't know this, but the IRS is a non-moralistic entity, and they can't make a judgment if the rule is codified in the tax code. They have to allow it. And so when Pablo Escobar was prosecuted by the Department of Justice, he wrote off all of his expenses, and he was able to do that. And so Congress was so pissed about it that they created the 280E, that you can't deduct expenses from an illegal business. So that's where it came from. I always like to share that little tidbit.
Yeah, I think it was a bunch of yachts in Miami, all these really expensive boats that were purchased with cocaine money. So it's an interesting thing. But yeah, there's a lot of opportunities that 280E don't provide cannabis companies. So labor expenses, for example, the highest pieces of the expense for a cannabis business owner can't be written off. There's 263A that allows you to move around inventory to take, less expenses, but that's a podcast for an accountant. So we're going to go ahead and skip that. With that, I want to roll this one up. I want to thank my guest, Rob Sechrist. He's a president with Ploris Equity Group. Thanks for being on the podcast.
Thanks so much. I appreciate your time and look forward to speaking with you again.
Yeah, we'll put some of the links to get a hold of you in the show notes. I am Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.
How do cannabis CEOs balance growth and optimization strategies? What is THCO, Delta-10, and CBNA, and why should you care about these minor cannabinoids? And why isn't the endocannabinoid system covered in medical school? Most people think they're up to date in trends in the cannabis industry, but they're about 6 weeks behind. Learn about what is truly next in the cannabis space by joining myself, Brian Fields, and Kellen Finney every week on the Dime Podcast, and of course, on PodConnects.